Hello friends, today I'm going to talk about a very interesting subject called investment portfolio. Now what is this investment portfolio? It is a very posh word or a very high word used by many of the mutual fund houses and all. Nothing. It is just very simple. I'll tell you in a very simple language what is portfolio. Portfolio is nothing but a combination of various investments you are making it from your side. For example, you would have invested in gold, you would have invested in real estates, you would have invested in equity share market, you would have invested in, say, bonds, you would have invested in small savings scheme. All these put together is nothing but your portfolio. So your investment portfolio is a combination of your investments in different segments of the market. As simple as that. Now, when you say that it covers different segments, every segment of investment comes with a risk and a return. The higher the risk, the higher the return. Now you have to decide which are the segments where you have to invest with no risk and less rate of return, where you are prepared to take some risk with a higher return, where there is extreme risk but also the returns are very high. So these are the three bifurcations which you have to keep in mind when you are starting to invest in these segments. Now let us try to analyze from a common man's perspective, what are the must to have in an investment portfolio, what are good to have and what need not form a part of your investment portfolio. Okay, now first let us take must to have. In this must to have category, your risk would be zero virtually, but your returns might be less, but it is guaranteed. In this segment of portfolio, you should be having life insurance policy, health insurance policy and your retirement fund, because you cannot afford to take risk on these three elements. They are mandatory for not only you, for every segment of the society. So this is very important, number one. Number two, you can take some risk because you want to have a higher return. See, those will go into your SIP or mutual fund or even for that matter gold. These are the second segments where you can invest, that you are not going to take too high a risk, but your returns are going to be a little higher than the first segment. Now the third segment is where you're going to take extreme risk, but if that clicks, you're going to get tremendous capital appreciation. So that is the third category, which is nothing but investment in equity share market directly, investment in real estates directly. So these are extremely high risk and high return investments. So my dear friends, when you are going through all these things, you have to maintain a correct proportion in each and every segment. You cannot try to put all the eggs in one basket because that is highly risky. Some people may have some passion towards real estate or towards equity share market or towards bonds and other things or forex currency for that matter. See, you have to, I do agree that the passion drives your investment, but there should always be a science and logic behind your investment because it is your hard-earned money. So your hard-earned money should be equally distributed, or rather logically distributed in all the three segments, what I'm trying to say. So when you are trying to allocate your investment, for example, let us say you are having 1,000 rupees. Okay. In your 1,000 rupees of investment, how do you distribute your portfolio? For the segment one, which is no risk, but returns are guaranteed, but less, you have to invest definitely 30% of your investment. The second segment, which allows you to have some sort of a risk and higher rate of interest, you should allocate another 50% on that. So 50 plus 30 will be 80%. The remaining 20% must go towards your risk-taking segments, which is equity share market, real estates, and other things. Because the reason why I'm trying to allot you this is, even if you lose the 20% of the segment 3, which is high risk, you will still be able to survive the 80% of your investments, which are safe and secure. Okay, but if you try to increase the proportion in the third segment, will you be in a position to bear the loss? Will you be in a position to completely, forget about the capital if something really unfortunate happens? Say, for example, the stock market is tumbling almost, say, about, 10%, just like what happened during pandemic. Will you be able to substantiate? Will you be able to resist that loss? That is a decision which you have to take. So let us try to see that our hard-earned money is not lost. At the same time, we need to also invest in those instruments which are going to give us high return because we want to also explore that sector. However, a lot of study and research is required into it, which you have to take it. So, just to sum it up, segment one which has got mandatory, which needs to be forming a mandatory investment in your portfolio, which is insurance and retirement planning. You must have that. Many people miss out on this and try to concentrate on the third segment, which is why they have huge financial losses when something negative happens. You should always remember that your portfolio is balanced. 30, 50, 20. This is called portfolio balancing. If you are able to balance your portfolio well, your returns are going to be very good. You will have peace of mind when you're sleeping. Your hard-earned money will come back to you at the right time when you really want it. Okay, but if your portfolio is heavily weighted in one of the segments, like segment 3 having 50% and segment 2 having say 20%, then only 30% in this one, then your portfolio is a little imbalanced, or rather it is disproportionate. So what you need to do at that point of time is you have to rebalance your portfolio. This rebalancing is shifting some of your money from the high risk to lower risk or with no risk at all. That is what is called rebalancing. So concluding the complete story here, have an investment portfolio which is distributed across various segments of investments with the right proportion so that you don't lose your money in the long run or in the short run. And if you want to know more about it, my dear friends, please contact me at the mobile number which is given in the description below, and I will help you how to create an investment portfolio, how to balance your portfolio, and if your portfolio is out of proportion, how to rebalance it. If you like this channel, please subscribe to it and hit the bell button so that you get more informative videos like this often. Please tell your friends and relatives also that this is very important, because if you are not going to take care of finance, nobody else will. You are the architect of your future.